When we talk about investor behavior, most people assume that better information leads to better decisions. But some of the biggest investing mistakes are not informational, they're emotional. The CFA curriculum separates emotional biases from cognitive errors for a reason. Emotional biases are not just errors in logic. They are rooted in how we are wired as human beings, and that makes them much harder to fix. One of the most powerful is loss aversion. Losses feel significantly more painful than gains feel good. That's why investors often hold on to losing positions too long, hoping to avoid the emotional discomfort of locking in a loss. Then there's overconfidence. Many investors genuinely believe they can predict markets or identify winners better than the broader market. This often leads to concentrated portfolios, excessive trading, and underestimated risk. Endowment bias is another common one. We assign more value to assets simply because we own them. This shows up frequently with employer stock, inherited assets, or long-held positions that feel familiar. Status quo bias causes investors to stick with the current allocation even when change may be appropriate. Regret aversion keeps people from acting at all because they fear looking back and feeling they made the wrong decision. Here's the key point. Unlike cognitive mistakes, which can sometimes be improved with education or better data, emotional biases are deeply ingrained. You cannot always eliminate them with analysis alone. That's why awareness matters. If you understand how these biases operate, you're less likely to let them quietly dictate your long-term outcomes. At Rimac, we believe good investing is not just about markets, models, or asset allocation. It's also about understanding human behavior. We design portfolios that account for both financial reality and emotional reality, so your strategy can hold up not just in theory, but in real life.